Putnam, the former economist at the CME, joining us here a day after CPI. Happy Valentine's Day to you. Wow, what a reaction to the CPI numbers. And after I saw it, after, the market tanked like it did, and, Dennis, came back on, and, we're talking about, you know, it was higher. It was hotter than expected. Talk to us about your expectations for the for the number and how the market reacted.
Well, I wasn't expecting it to tick up the 1/10 it did on the month over month. So, it's a little hotter for me too. Uh, but when you look at it, I mean, these numbers, economists aren't that good at getting every 1/10 right. And there's a decent amount of volatility in the monthly numbers. So I don't see anything really different going on. If you look at the year over year numbers, they actually improved a little bit. It was the month over month that surprised people. People are looking at the month over month now more than the year over year because Jay Powell told them to. He said, I gotta get more confidence. And so you get more confidence each month. But if you look at the year over year and in the CPI, not even the PCE, but the CPI, and you take out shelter, you've been under 2% for like 6, 7 months. So you're still there. Didn't change yesterday. The problem yesterday was in shelter, not shelter, services, sorry. And services are going to be higher than goods. Goods, there is no goods inflation left. So you're just averaging services with goods, and you're getting your inflation rate down. So I didn't see any major change. Jay Powell already told us they're not cutting rates in March. An amazing number of people didn't believe him, but he was pretty adamant. So I think they believe him now. That's what came through yesterday. It could be July before they actually start cutting because they definitely want to see a few more months.
Okay, I just got your charts here, Aaron. If you could share my chart here, the annualized inflation based on the last 6 months, pretty accurate description here. So it really, the core, it was a little bit hot. You mentioned the shelter there. Let's move on here
Wait a
to
minute, stay on this one just 1 second.
sure, go ahead.
This chart is becoming more important because of the idea that the Fed needs to gain confidence. So we're just looking at the last 6 months of data, looking at the month over months and annualizing that. And so you can see the CPI core is just a touch higher than the CPI, but you take out shelter and you're in great shape. So that's what people are looking at to gain confidence. By the way, the Fed does not target the CPI. It targets the PCE core inflation rate, which is lower.
That's a
Okay,
great
it looks
point.
like, yeah, go ahead, Christian.
Yeah, it's a great point. I mean, the CPI is not the only measure, certainly out there, and Blue, hits the nail on the head. I mean, their favored inflation gauge is the PCE deflator. Now, of course, like the market for whatever reason has been more focused on that number, but we'll see. And we've got a number. Clearly the expectations for a March cut really moved down into basically nothing, which is I think is good that the market's not implying that that's going to happen anymore. But that said, I mean, we're going to get so much more data that comes out too. We don't know if this report is a one-off, and as Dennis said yesterday, it's a tenth of a percentage point,
Yes.
above expectations. It's really, you know, all things. It's not that big of a deal to see just 1/10 of a percentage point higher. We'll
Oh
see
yeah.
if
If,
this is a
if you
trend.
get if you get focused on a 1/10, you're not paying attention to the volatility of the data. It's like asking a
Exactly.
weatherman to get everything exactly right. They're not going to do that. Neither are the economists. By the way, this chart is the PCE core, and this is the one the Fed watches, and it's been below 2% on this 6 month basis for all of 1 month. And that data comes out at the end of the month. So, it could easily tick up 1/10 too and be back there. But what it's telling you is inflation really is pretty close to 2% on the core basis that the Fed looks at. They're not far away. They just want more confidence.
But why do they act like they're so far away, and then in the same breath, so ready to talk about cutting interest rates?
Well, if a recession were to develop, then they would have to cut rapidly. But if the recession does not develop, and it looks like we're going to cruise into the first and second quarters of this year doing just fine, labor markets are fine, then it buys them the time. And they really don't want to make a mistake. They would rather be late because they don't feel any urgency here. The economy's doing fine. They don't need the urgency is not there. So they think they can take their time. I really wouldn't argue with that. I mean, if I would probably have cut sooner because I'm already convinced, but they're not, so they can wait.
Just as they were slow to react on raising rates, and you're kind of foreseeing that same scenario here. They were late on, excuse me, raising rates. You think they'll be just equally as slow in bringing them back down?
As long as we don't have a recession, the answer to that is absolutely yes. Um, the thing is that what we saw in the market yesterday just reminded us of how important rates are to the market,
Mm-hmm.
but the rates are not that important to the economy. The economy, the jobs market is dancing to a very different drummer than the S&P or the Nasdaq, things like that. So if they slow on raising rates and slow on cutting rates, doesn't matter to the economy, but it does matter to the equity markets. By the way, this last chart is kind of fun. This one is takes you back to 1960, compares the federal funds rate, which is the lighter blue line on top, with PCE core inflation, and it really tells you that the last decade is the outlier, where they kept rates just so low for so long, and that's why we had such great bond and equity markets until they started raising rates. And I think what the markets, I mean, the equity markets have to really consider is, do we need to get out of worrying about whether rates go up or down a quarter of a point and really focus increasingly about earnings? Because the Fed's going to keep the Fed funds rate above the rate of inflation, just not quite as
No
much as it
matter
is
what.
right now. So I think we're in a transition period for the stock market where we're going to learn not to be quite as skittish, if you will, about 0.1% on the inflation like yesterday, and really start, like where are we gonna be on a couple of years out earnings? Which are the industries that are gonna make it? Which industries are AI gonna disrupt more than others? So I think we're about to head into a much more earnings driven conversation, which I will certainly welcome.
Blue, just a quick question for you. I mean, considering that it was just a tenth of a percentage point higher than expected, do you think it was just more about that the markets had been on such a nice run and were basically priced to perfection going into that report?
I won't argue with that. They were definitely on edge because there were plenty of people worried that this rally couldn't continue, and they got that one little trigger of information, and wow, did they sell fast? But we're grinding a little bit back today. The other market that got hit, interestingly, and is gold. The higher for longer on rates is not good for gold, and the stronger, the healthier economy is not good for gold. So I think we're down below 2,000 again on gold. So that's another one that's impacted here.
Before we let you go, Blue, we got to talk about, the banking system. We got to talk about what went on with NYCB. Looking at this as, or the street at least is reacting that it's just a one-off. The higher the rates stay up here, the more these banks are going to be, upside down on their loans. And, we all know, it's not the biggest part of the market here, but looking at the financial sector here, not looking like any individual names. I mean, this is not good for them, right?
Well, the regional banks that have a very, very large exposure to commercial real estate in the largest cities, they're in big trouble. But regional banks that are outside the big cities, they'll turn over their loan portfolios. They're not going to have much increased credit risk. They're going to be fine. Uh, Not great, of course. Their earnings are not going to be as good as you might want, but we're not talking systematic risk here or anything like that. So, and I can't figure out who hadn't gotten the message that commercial real estate in the big cities was in trouble. I mean, I was having a conversation with my dog the other day, and he couldn't figure out why people didn't already know that. I mean, that email's been out there.
Yeah, it certainly has. So, all right, we're gonna let you go here. We've been on the line with Blu Putnam. He's the former chief economist at my old stopping grounds, the CME.